Hi everybody. Today we are looking at capital rationing. In the introduction of this course, financial management, I said that it can be looked as what as the management of finance. And what is the finance we are talking about here is capital. Because that is the lifeline of a business. Fund. The company uses fund to do what? To run both its short-term, medium-term, and long-term operations. To finance both its short-term, medium-term, and long-term operations. And that, therefore, fund is very crucial to the survival of a business. And this fund we are talking about is also limited in supply, because a company tends to do what? To expand day in, day out. For example, Dangote group of company, as big as it is, it keeps looking for opportunities of expanding. By that, therefore, it's going to need a lot of capital to do what? To invest on new projects. May have a list of projects or viable projects. A company may have a list of viable projects in which this project, if embarked upon, is going to do what? Increase the weight of the shareholders or of the stakeholders, as case may be. In that wise, therefore, there are some certain situations whereby the company will not be able to do what? To invest on these viable projects in which it has at hand, due to the fact that there may be shortfall of capital to be used to do what? To finance this project. But that, therefore, the company will now tend to do what? To ration this capital, this limited source of finance, limited capital, on certain projects, in which this limited source of finance may span over 1 year or a period of time, as the case may be. By that, therefore, the company will then look at a way of sharing this available fund on the investment available, on the present investment, on the investment it has at hand. By that, therefore, we call that situation rationing. We are rationing. You ration the little fund you have among various alternatives. So the alternative that gives the company the highest return, probably in terms of net present value or profitability index, we tend to do was to take this fund first. We allocate fund to this investment that gives us the highest net present value. We now measure further in terms of benefit cost ratio, which we have spoken about in investment appraisal techniques. Net present value. So by that, you have to do what? Appraise all your investment before you tend to know which one should I give this fund to first, in that order, and that in which order should I do allocate these scarce resources. So by this, capital rationing occurs whenever there is a budget limit. That is, the budget limit in terms of you cannot make your budget beyond a certain level. That is, this is the capital available. You cannot make your budget beyond the capital available. Or a market constraint on the amount of fund available for investment during a specified period. So when looking at a budget limit is is an internal factor. It is the management of the organization that do what? To prepare the budget, the finance manager that prepare the budget of the organization. So by that, is what to this can be viewed as what, as internal factor or a market constraint. The market constraint can be viewed as what to, as the external factor affecting what, investment on projects. Wherever there is a budget limit or a market constraint on the amount of funds available for investment during the specified period. I want to understand the concept of capital rationing. Now, what are the causes of capital rationing? The causes of capital rationing can be said to be what? Internal or soft capital rationing. You can have the situation of what, when the capital rationing, when the rationing is a factor of what, of internal factor, which is also called as what, soft capital rationing. Or the external factors, which we refer to as what, the hard capital rationing. The internal factor, these are factors, these are causes by what to, that is being placed on what, on finance by the internal factors. What are the internal factors? The management of the organization. That is within, it is a within factor that places restriction, that places limit on what to, on capital, which at the end of the day it leads to what, to rationing. So example of these internal factors of capital rationing can be the manager may decide that for this period we don't want to spend too much money. We don't want to spend above a particular limit, above a particular ceiling. We have a ceiling. The manager may decide that for this period we are going to have a ceiling on what you are going to spend. By that, therefore, the company won't be able to do what, to invest on what, on all the projects. By that, therefore, it's going to pick the projects on which it's going to invest on. Also, the management of the company may also say, still under the internal or soft capital rationing, management of the company may also not want to do what, to dilute control. So for example, if the fund available in the company is not enough for the company to do what, to invest on projects, the next thing for the company to do is to do what, to go out, to go to the market, to the stock market, to the capital market and go and raise funds. But the management may tend to not to do what, tends not to dilute control, because going out to do what, to source a fund, either by equity or by debt, by debenture, the company is therefore diluting the control. And the company may don't want to do what, to dilute control. By that, there will be restriction on the capital available to do what, to invest, or there will be restriction on investment on what, to, on projects. So the fear of not diluting control is another factor under the soft capital rationing as one of the cause. The fear of not incurring a fixed cost capital, such as what, the venture, may also what affect, is also a factor under the soft or internal capital rationing. Also, the management of the company may not have what, the competent hands to do what, to handle a particular project. So therefore, there will be restrictions. So we won't be able to do what, to invest on those projects. So we have a lot of what, of factors which constitute the internal or soft capital rationing. Majorly internal is what is within. One external, which is what, the budget limit. The factors constitute that budget limit. While the external or hard capital rationing, these are the factors that place what, restriction on what to place constraint on investment based on what, on external factors such as what, or market constraints, or the market. Number one, the company may not have what, a good credit rating for it to approach the financial institution to do what, to seek for fund, to source for fund. By that, therefore, there will be restriction on what, they be constrained on what, on project investment, on investment on what, on projects. So also there will be government restriction placed on what, on the company not to do what, not to approach any not to source for any external fund at a particular period of time. There may be agreement between what an existing company and its what and its creditors, such as what debt holders, in which at also period, if you have not paid a certain amount of, if you have not fulfilled certain obligation, you cannot source for fund outside in the public. So these are a host of what of factors that do cause what that do lead to what to capital rationing. By that, the company will tends to do what to spend the little available resources on what to ration the little available resources, which is the fund, and on the available project. By that, it's going to do what ration it among between what to the project in their order of what of return to back to the company. So this is an introduction to what to capital rationing. The next video, I will be treating the types of what capital rationing. So by this has introduced the topic to us. This should make us to do what to understand anything we are going to talk about. We're going to be talking about under capital rationing. At this junction, I will call it a day. Please, if you have not subscribed to the YouTube channel, kindly click on the subscribe button. Share the video with your friends and family. Give us what? Like the videos. In the comment section, put in place a comment there, anything you observe. Please kindly do that and do what? I'll be happy to do what to receive your comment, and I'll be glad to do what to feed you back, to respond to your comments. At this junction, we're going to call it a day now. Please watch out for the next video on types of capital rationing. Thank you.